Your money-making broadcast starts now. Wall Street closed with sharp divergence on Monday, May 4, as crude oil surged past $105 per barrel amid escalating tensions in the Strait of Hormuz, sending energy stocks sharply higher while consumer discretionary and technology names faced significant selling pressure. The S&P 500 managed modest gains on energy sector strength, but the Nasdaq Composite struggled as semiconductor stocks showed extreme bifurcation. The Berkshire Hathaway annual meeting marked a historic leadership transition with Greg Abel's solo debut as the legendary investor's designated successor, generating fresh interest in Berkshire's energy holdings. Anthropic announced a landmark $1.5 billion AI venture backed by Goldman Sachs and Blackstone, signaling Wall Street's deepening commitment to independent frontier AI research. On the macro front, Berkshire predictive market data pointed to a stronger-than-expected April non-farm payrolls report, while J.P. Morgan CEO Jamie Dimon issued a stark credit recession warning that kept defensive positioning at the forefront of institutional portfolio discussions. All of this unfolded against a backdrop of accelerating geopolitical risk in the Middle East that could reshape global energy markets for months to come. The divergence between energy and technology sectors underscores the unusual rotation underway as geopolitical risk reshapes investor priorities away from growth and toward tangible assets with pricing power tied to real-world supply constraints. The oil crisis dominated today's trading session as fears of a Strait of Hormuz disruption drove benchmark crude prices above $105 per barrel during intraday trading. The Strait of Hormuz is a critical choke point through which approximately 20% of the world's oil supply transits daily, and any sustained disruption threatens to upend global energy markets. Analysts at multiple investment banks have projected crude could reach $125 or higher if the situation escalates, with worst-case scenarios exceeding $150. Energy stocks led the market higher as a direct beneficiary, but airlines, shipping companies, and consumer-facing businesses with heavy fuel exposure faced notable headwinds. Occidental Petroleum gained 2.5% to close at $60.18, benefiting from both the spot oil rally and the halo effect from the Berkshire Hathaway annual meeting where Greg Abel made his solo debut as the legendary investor's designated successor. The meeting reinforced Berkshire's deep conviction in OXY as a core energy holding, with Abel echoing Buffett's long-standing thesis that American oil production remains strategically undervalued in the current geopolitical environment. The Berkshire Hathaway annual meeting in Omaha drew record attendance as Greg Abel took center stage for the first time as the sole leader, marking the most significant leadership transition in the conglomerate's 60-year history under Buffett. Abel, who oversees Berkshire's non-insurance operations including its massive energy and utility portfolio, demonstrated a command of the conglomerate's diverse businesses that reassured longtime shareholders. Analysts noted Abel's extensive background in energy and regulated utilities, which aligns naturally with Berkshire's growing focus on Occidental Petroleum and broader energy infrastructure investments. The meeting highlighted OXY's importance to Berkshire's portfolio strategy, with Abel explicitly confirming the conglomerate's commitment to its roughly 28% stake in the energy producer. For Berkshire shareholders watching from Omaha and around the world, the Abel era represents continuity of Buffett's capital allocation principles combined with a more hands-on operational approach. In technology markets, Anthropic announced a $1.5 billion AI venture backed by Goldman Sachs and Blackstone, marking one of the largest institutional commitments to frontier AI development outside the major technology platforms. The funding will support expanded compute infrastructure and the scaling of Anthropic's Claude model family for enterprise deployment. This deal signals that Wall Street's largest financial institutions see substantial long-term value in independent AI research labs that are not tethered to the big tech companies. The venture structure suggests Anthropic is positioning itself as the enterprise-grade alternative in the AI assistant market, with Goldman and Blackstone providing not just capital but also distribution channels across their extensive portfolio companies. Oracle shares gained on the read-through that enterprise AI spending continues to accelerate across the board, benefiting cloud infrastructure providers. The involvement of Goldman and Blackstone specifically signals that institutional capital is pivoting toward AI infrastructure as a long-duration asset class with predictable returns tied to compute demand growth. UPS experienced its worst single-day decline in years, crashing 10.5% after reporting weakening parcel volumes across both residential and business segments combined with rising operational costs tied to fuel and labor. The logistics giant's revised guidance suggests the broader economy may be cooling faster than previously anticipated, raising new concerns about consumer spending durability heading into the second half of the year. The transportation sector often serves as a leading indicator for economic activity, making UPS's decline particularly notable for macro watchers. PayPal announced a strategic restructuring that will spin out Venmo as a standalone business unit, aiming to unlock shareholder value from its popular peer-to-peer payments ecosystem that has struggled to fully monetize its user base. The move follows sustained activist investor pressure to streamline operations and separate high-growth assets from the core payments business. GameStop CEO Ryan Cohen is reportedly exploring an acquisition of eBay, though the move faces significant skepticism given GameStop's limited financing capacity and a strategic mismatch between a video game retailer and a global e-commerce marketplace. Semiconductor stocks showed extreme bifurcation in today's session, with memory and enterprise infrastructure names outperforming while GPU-focused and legacy chipmakers struggled. Micron Technology surged 6.3%, driven by tight high-bandwidth memory supply for AI workloads in data centers. HBM is a critical component in AI accelerators, and Micron's advanced HBM3E products are in high demand from hyperscale data center operators racing to deploy AI infrastructure. The supply-demand imbalance gives Micron significant pricing power that analysts expect to boost margins for several quarters. Oracle added 5% as its cloud infrastructure business accelerates on enterprise AI adoption, with management reporting strong growth in AI workload bookings during recent investor calls. On the downside, Advanced Micro Devices fell 5.4% as competitive concerns in the AI chip market weighed heavily on sentiment. Intel hit a new 52-week low of $95.68, extending its prolonged decline as the company's turnaround plan continues to face execution headwinds and persistent market share losses in both data center and client computing segments. The contrast between Micron and Intel encapsulates the divergence within the semiconductor industry, where companies tied to the AI buildout are thriving while those dependent on traditional computing cycles face structural headwinds. On the macro front, Kalshare Predictive Markets suggest the April non-farm payrolls report due Friday will surpass the 57,000 consensus estimate, with implied probabilities pointing to a print closer to 100,000 or higher. A stronger-than-expected jobs number could complicate the Federal Reserve's rate path and reinforce the higher-for-longer interest rate narrative that has weighed on growth stocks. J.P. Morgan CEO Jamie Dimon issued a stark credit recession warning during a conference appearance, urging investors to exercise caution on consumer loan exposure as credit card and auto loan delinquencies begin to rise from historic lows. Dimon's warnings carry particular weight given his bank's position as America's largest lender with the most extensive consumer credit data. Kevin Warsh has emerged as a leading candidate for Federal Reserve Chair under the next administration, which could signal a shift toward tighter monetary policy and a more rules-based approach to rate setting. Chinese technology and AI stocks received a modest boost from new government policy initiatives in Beijing supporting domestic AI development, though gains were limited amid ongoing trade uncertainty and tariff concerns. In currency markets, the dollar strengthened on safe haven flows tied to Middle East tensions, adding another layer of complexity for emerging market exposure. For tonight's stock picks, we turn to four legendary investors with distinct approaches to capitalizing on today's market conditions. The father of value investing, Benjamin Graham, would find Pfizer at $26.35 compelling as a defensive pharmaceutical holding with recession-resistant earnings and a strong dividend yield near 6%. He would emphasize the significant margin of safety in its current valuation relative to book value, noting that Pfizer's diversified drug portfolio provides stability across economic cycles. In an environment where geopolitical risk is rising and growth narratives are being challenged, he would advocate for the disciplined purchase of assets trading below intrinsic value with identifiable catalysts for mean reversion. Philip Fisher, the growth investing pioneer known for his scuttlebutt approach, would select Oracle at $180.35 as a compounding story where enterprise AI adoption drives accelerating cloud revenue growth. He would focus on management quality, the durability of Oracle's competitive advantages in database and cloud infrastructure, and the long runway for AI-related enterprise spending. Cathie Wood, the disruptive innovation investor, would highlight Micron Technology at $576.45 as a structural bet on AI memory demand and semiconductor supply constraints. She would argue that HBM supply tightness gives Micron pricing power that the broader market has yet to fully price in, with multi-year growth driven by data center AI deployment. For growth-oriented portfolios seeking exposure to the physical layer of the AI infrastructure build-out, Micron represents one of the purest available options with tangible near-term earnings momentum. Sir John Templeton, the global contrarian investor, would pick Occidental Petroleum at $60.18 as a crisis-driven energy play backed by Berkshire Hathaway's nearly 28% stake. He would apply his principle of buying during maximum pessimism and geopolitical fear, noting that today's oil supply disruption fears create asymmetric upside for patient capital willing to look past short-term volatility. The combination of Berkshire's institutional backing, a tight global oil supply market, and crisis-driven valuation dislocations creates what he would recognize as a textbook margin of safety in an unloved sector. I'm Chloe. I am Chloe. See you tomorrow for another Market Close recap. Check our shorts for a 60-second highlight. That's all for today. We all become wealthy together.